Hello everybody and welcome back to my channel. Today I have a bit of an interesting video for you. So I've been doing a little bit of research, specifically trying to compare active versus passive investing. And so one of the approaches I took to this that I was kind of able to find a lot of interesting conclusions from was I actually took well over 100 actively managed funds that I thought would make great comparisons to the S&P 500. Now for the S&P 500, I use the Vanguard S&P 500 ETF for the comparisons. And so what I wanted to kind of do is break down in a 1, 3, 5, 10, and 20 year period how a lot of these actively managed funds actually compared performance-wise to the Vanguard S&P 500, and also taking into account afterwards just simply from price to also going into yields and fees and taking that into account as well. So a little bit of intro to kind of go over why I wanted to do this. It's typically taught in at least finance education that active management is a scam. Like straight up, these people, a lot of them underperform significantly to the S&P 500 or to even their benchmarks in general, and even learning courses for doing stuff for like the CIPM exam or other certifications. You learn all about the process of switching benchmarks, as active management, if they're underperforming their current benchmark, will frequently switch benchmarks to try and get an edge over that one, even if they aren't necessarily the greatest fit. So really, to start kind of the process, what I wanted to do was find funds that actually compare themselves to the S&P 500. And what I found was actually quite shocking. See, a lot of these funds that deal with companies in the S&P 500 exclusively, a lot of the funds, they don't use the S&P 500 as their benchmark. And I was a little bit taken aback by this because for me, if I wanted to run my own fund one day where I was specifically using the S&P 500 companies and maybe just weighting different or doing a different strategy, I would personally use the benchmark of the S&P 500 because I think that's the most accurate representation of how I'm doing. And saying that out loud, can see why they would decide to use benchmarks that don't fit, that underperform consistently, and just aren't very good. Because when you look through on Morningstar, when you look through on these actual company prospectuses, a lot of them are crushing their benchmark. And then you try and find their benchmark, and it's something you've never heard of. It's some random Bloomberg benchmark. I guess there are hundreds of benchmarks that you can pick from, and a lot of them just choose crappy ones. So now getting into a little bit of what I actually found. So I wanted to see how many of these funds actually consistently outperform VOO. Again, the most simple, very low turnover fund out there that is the largest fund on earth for a reason, or ETF. So first I went straight from price appreciation comparisons, and only 25% of funds had higher returns than VOO. Now, again, sample size wise, over 100, I don't think that's necessarily enough to go definitively, only 25%, and slap that number as your percentage forever. But I do think that you can get some good trends out of analysis like that. I'm sure if you did 1,000, 2,000, it might be a little bit different, but seeing how infrequently they actually beat the S&P 500, that should be a sign. So then I took it one step further. I incorporated dividend yields, and I took out the expense ratios that come with active management from these funds. And I was left with 12% of the funds outperforming the S&P 500 across the different timelines. Now, for me, that's kind of jarring. I'm going to be honest. Also, I'd like to say, out of the funds that outperformed them, all of them were growth, and they were all very overweight in technology. I think that's important to say. But looking at the funds I was left with, it was kind of worrying to see. I'm going to be honest, because these are supposed to be the professionals of the professionals, and they can't even beat like the benchmark. So definitely concerning, especially when you kind of break into their positions. Again, you see very overweight in information technology, maybe even as much as 10% higher than the S&P 500 weighting, and then all of them were very, very underweight in defensive companies and sectors. You weren't going to see hardly any Walmart, no Exxon, very, very little anything in consumer staples, maybe some Philip Morris, though, that's still kind of growthy, but consistently, you are going to find very overweight growth, high risk portfolios, and those were the ones that outperformed. Now, there is kind of a problem with the approach of trying to find consistent year-over-year outperformance. And that kind of comes down to when you look at some of the great investors like the Warren Buffetts, the Charlie Mungers, or even some of the hedge fund people like Ray Dalio, what you're going to see a lot of is it's not about consistent outperformance. And that's one of the problems with this kind of argument that, yeah, the active management doesn't necessarily beat them every single year. It's really, really hard to outperform the S&P 500. But also, I'd say if you're maximizing your risk, like there have been years where Warren Buffett has absolutely underperformed the S&P 500. I mean, we're talking about a guy who outperforms like a decent bit over 70% of the time, but there have been years where he's absolutely underperformed. And then on the contrary, there have been years where he has doubled or even tripled the market's returns for that year. So I think it's important when you go about these decisions to understand kind of some of the flaws with trying to specifically look at year-over-year consistent performance compared to these. But that being said, I'm still left with the general impression that a lot of active management should be avoided, because at the end of the day, it's really, really hard to find these managers who consistently outperform, as there's quite frankly just so many of them. And their track records don't necessarily reflect their skill or competence or knowledge. Because I'm sure, again, if you talk to these people on a day-to-day about finance, they'd probably run laps around your head at just some of the knowledge that they kind of bring to the table, because that's their life. That's what they do for 8+ hours a day for years at a time, is looking, researching, understanding, things of that nature. So like, I'm sure teaching wise, these are still good people that you'd want to actually follow. A lot of them are CFAs, and yeah, but this just kind of shows how hard it is to actually beat the market, and kind of shows again why on this channel specifically I've been very, very pro passive investing, for at least if you're not wanting to do it as your only thing, maybe you really, really love individual stocks, looking into something like the core satellite approach, where you really do make VOO and maybe a couple other ETFs the cornerstones of your portfolio, just because statistically you are much, much better off doing that. Now, of course, there are going to be outliers, and there are going to be people who do outperform, and even my study kind of showed that. There were still definite funds that were actively managed that outperformed the S&P 500 consistently. That being said, can they replicate that over another 20 years is a different question entirely. So, active management, is it a scam? That's the whole purpose of me going through this and trying to discover this. Is active management a scam? I'm still leaning towards no. And again, it's for the reasons I mentioned before, which is a lot of these active managed portfolios, yes, some of the trends we've found. Value significantly underperformed growth in the past 20 years. And then, if you were overweight in technology, you did significantly better than the market over the past 20 years. Those people and those portfolios that really did outperform, they outperformed by a wide margin. Like, it wasn't close. Again, if somebody asked you day one, would you rather invest in Warren Buffett, I know I keep bringing that up, but would you rather invest in Warren Buffett or invest in the S&P 500? Invest in Berkshire Hathaway 1965 versus the S&P 500. You would rush to investing in Berkshire Hathaway before the S&P 500, knowing what you know now, knowing about who this man became, is one of the greatest investors of all time. And there would be years you'd look at him and be like, why did my shares go down 50% in a year where the market had a positive year, you bozo moron, you lost all of my money. And at the end of the day, those are the consequences that come with accurately using your risk. When we're talking about a company, or we're talking about somebody who's early on in their careers, or someone at the beginning of their life cycle, you arguably should be running the risk of going down 50% in a year to maximize the potential returns you can have. Like, yes, I know deep down if I wanted to never ever lose money ever, I could just build a ladder of CDs forever. I also know that by doing that, I could potentially be pushing back my retirement by decades. Potentially. Let's just be honest. Look into life cycle investing. It's not worth it. You could consistently get your 4% return a year. Or you could have an average annual return of 10% per year. And then that may not even sound like a huge difference, but with compounding interest, it's a massive difference. So, yes, active management in terms of should you invest in VOO and forget it? Yes, you should invest in VOO and forget it. Probably for 92% of people on Earth, that's going to make sense. If you're not actively doing your research all the time, that's going to make sense. And then also, what I've realized is a lot of individual people, this is just going to be a little bit of a side tangent in general, but a lot of people should not be making their own financial decisions. And so that's also where I see the value of active management. In the same way that maybe, for instance, you live a very, very unhealthy life. Like, there are people who live very unhealthy lifestyles. They don't take care of themselves. They don't eat well. They don't go to the gym ever. And I'm not saying you need to go to the gym. Even just doing some basic exercise like walking around is going to have benefit from doing nothing. But they drink all the time, smoke all the time, add in all the bad factors, right? And they will look you dead in the face, and I know these people, they will look you dead in the face and tell you with full confidence that they know more than their doctor. It's like, buddy, this guy has gone to school for 8+ years learning this one thing that he has chosen to make his life about, or she has chosen to make her life about for 8+ years, and then has a practice and has worked on thousands of people and is telling you to not treat your body terribly. Maybe you should listen to them. And a lot of this boils down into the same way that there are bad active managers and some people that really outperform or are sketchy, or Bernie Madoff. They hear these one-time instances, one-off instances where people are bad. Because let's face it, there are bad people. There are sucky people. There absolutely are. They are in every field. They are in every country. They are in every continent. There are bad people. They hear about this thing, and then they decide that they're never going to trust anyone in that industry at all, ever again. And it could be like the most basic peer-reviewed research, like chain smoking cigarettes all day is not good for your health. I feel confident saying that. I'm just saying. But it could be multi-peer-reviewed, like 100% truth, backed with decades and decades of research, shown to multiple doctors, approved, and they'd say the medical industry is a scam because so-and-so I know 4 counties over got in trouble for prescribing people drugs they didn't need, and therefore all of medicine is a scam, and I'm not going to listen to that, and I'm going to continue to chain smoke all day. And again, that's your decision. You're a person. You have free will. At least in this country, you have free will. You can go about doing that. But that doesn't give you a right to just be like, hey, all of these professionals are wrong. They don't know anything. I know more than them about their literal line of work. And I think in finance, a really, really good example of this that I've heard a lot recently from people, if I try and talk to them and they don't understand things, is a lot of people will come up to you, and if you're invested at all, they'll try and be like, hey, what should I be invested in as my primary investment vehicle? And then they'll tell you that they're looking for a very, very high returns all the time, because for some reason there's this misconception that you're just going to become a multimillionaire by investing it all. You're not. It's a long process if you're doing it right, but they come at you with like these completely bloated expectations, and then also they don't ever want their money to go down. At the same time, they want to take on all of this risk that they don't know they're taking on by requiring a 35% return every single year. And it's like, that's a hedge fund. You can lose money in that, you know. But they don't want to have any of the potential downside, and they'll ask you like, oh, what should I invest in? And you just look at them and you're like, oh, just put all of your money into VOO. Like if I had one investment, somebody came up to me and was like, Torin, you can only invest in one company, one ETF, one fund for the rest of your life. I'm picking VOO and I'm writing it, because if that goes down to zero, money's going to be the least of my concerns. The United States is going to be nuked off the face of the earth. I'm going to be dead instantly. Doesn't matter. But you'll say VOO, and they'll be like, oh, what's that? And you'll be like, the ETF from Vanguard that is the S&P 500 ETF from them. And they'll be like, okay. And they'll look at it and they'll be like, oh my God, it's so expensive. And you just have to look at them and be like, well, what do you mean it's expensive? Because like you're coming at this from a standpoint of net asset value and things of that nature. And they're coming at it from like this $500 investment into an ETF that tracks the S&P 500 is comparable to this $20 stock, and it's not. And these are also people who weirdly are all investing in XRP and Solana. Don't know why. Don't know why. I've found this trend. It's funny. They hear about crypto, they learn about crypto, and they immediately go to XRP and Solana. Can't even tell you the difference. Can't describe what a blockchain is. Shouldn't be managing their own money at all. But that's the truth. And so you're talking to them. They think Vanguard S&P 500's expensive. They're invested in rando cryptocurrencies because they heard about Bitcoin booming. They don't even know like the thesis behind Bitcoin, a fixed amount, trying to make a currency that can't be inflated away. It's not like they're going to describe that to you and talk about that to you because they don't really know. And it's like, it's not necessarily like these people are coming at it from a place of I know more than you or anything, but it's just like, these are the same people that like, if there was one share of Chipotle, let's say there was a single share of Chipotle, and it cost $1 million. Again, for most people watching this video, they're going to be like, oh my God, that's the cheapest thing ever. I'd buy that instantly. But $1 million, these people would be like, oh my God, that's way too expensive. We're talking about a company that like literally last quarter did billions in revenue and had like $300 million in net earnings. If somebody came to me with that offer, I'd be calling every single person in my contact list I knew with money and begging them for a loan. And then calling every bank I knew ever and asking for a loan. And going into as much debt as possible to get 100% ownership of Chipotle's business. Like, share price is not an indication of how expensive a company is. If you do not understand that, please park your money in an ETF that tracks the S&P 500 and maybe has some international exposure, and just only use that as your investment vehicle. Do not just follow hot AI names you've heard about and then be like, buy financial futures set. I'm invested in Solana, XRP, and Nvidia. We're going to the moon. No, you're not, bud. You're going to Section 8 housing is where you're going. You're going to the streets. One bad market swing. Also, these people, one bad market swing. Oh my God, I lost $300. I'm selling everything, liquidating everything. I'm burying my money in the backyard. I'm not trying to make fun of these people. I'm really not. It's just, if this is you, don't invest in individual stocks. Understand your strengths and weaknesses when it comes to your own money. Okay, that was a side rant. it was fun for me. I got it out, so that was nice because I've had multiple of those conversations with people, and it always boils down to me trying to give them like really basic, easy, understandable plans that like they don't have to really know anything about and can be comfortable and live their life. And then they question you and just continue to question you, and it's like, but this is like my favorite thing on the face of the earth. I don't tell you how to do your job. Don't come to me and be like giving me finance advice when you can't walk through a business model of the company you're talking about because you saw it on a Wall Street Bets post. Maybe. Okay. So, anyways, thank you for checking out today's video. Active management, is it a scam? No. Is it a great investment? Probably not. Should you invest in it? No. I'd just park my money in VOO and call it a day. And then maybe build out a little bit around that. You could do some VOO, some QQQ, maybe a couple individual companies if you really like them, or if you think they stand like significantly far away from the competition and have big moats. Call it a day. You're going to be living great. Okay, thank you for checking out today's video.